Regular investors look at a building and ask, what can I sell it for? Family offices ask a better question. Can this asset feed the family for the next 100 years? That one question changes everything. Look at New York. Joseph Durst came to America from Poland and bought his first building in 1915. More than a century later, the Durst organization is family-run and owns, manages, and builds roughly 16 million square feet, including One Bryant Park, 151 West 42nd Street, thousands of apartments, and a major role at One World Trade Center. The Dursts didn't build wealth by flipping the skyline. They bought irreplaceable locations, improved them, leased them, refinanced them, and passed control down. The Rudin family followed the same formula. Samuel Rudin founded Rudin Management in 1925. Today, the family oversees 32 New York City properties, 20 residential buildings totaling about 4.5 million square feet, and 12 office buildings totaling about 8.6 million square feet. That is not a trading account. That is a private infrastructure system. Then there's LeFrak. Harry LeFrak started the business, and Samuel J. LeFrak turned it into one of America's great apartment empires. LeFrak City in Queens was not one building. It was a housing platform. Newport in Jersey City was not one deal. It was a master-planned neighborhood across the Hudson from Manhattan. Richard LeFrak inherited that base and kept expanding it beyond New York. That's the family office mindset. Don't just own a building. Own the neighborhood, the parking, the retail, the apartments, and the long-term cash flow. Fisher Brothers started in 1915 with Martin Fisher, later joined by Larry and Zachary Fisher. They began with housing, then moved into Manhattan office towers. Their portfolio grew to include 299 Park Avenue, 1,345 Avenue of the Americas, 605 3rd Avenue, and Park Avenue Plaza. Again, the pattern is obvious. Buy hard assets in markets with limited land, hold through cycles, modernize when needed, and let tenants pay down yesterday's debt with tomorrow's dollars. The Milstein family shows another version. Paul and Seymour Milstein built major New York holdings, including apartments, offices, and hotels. In 1986, the family acquired Emigrant Savings Bank, turning a real estate balance sheet into a banking platform. Real estate creates collateral. Collateral creates borrowing power. Borrowing power creates more acquisitions. And a bank gives the family another engine of capital, relationships, and deal flow. Tishman Speyer is newer, but the principle is the same. Jerry Speyer and Robert Tishman formed the company in 1978. The firm became tied to Rockefeller Center, the MetLife Building, the Spiral in Hudson Yards, Mission Rock in San Francisco, and major assets around the world. Jerry's son, Rob Speyer, now leads the company. That is what generational real estate really is. Not just ownership, but succession. The asset has to outlive the founder. Outside New York, look at Hines in Houston. Gerald Hines founded the firm in 1957 after starting as an engineer. Today, Hines has developed, redeveloped, or acquired more than 2,000 properties and manages hundreds of properties across hundreds of millions of square feet. His son, Jeff Hines, and granddaughter, Laura Hines Pierce, helped carry the platform forward. A different city, same formula. The Crown family in Chicago shows how real estate can sit inside a larger empire. Henry Crown built Material Service Corporation, merged it with General Dynamics, owned the Empire State Building for a period, and the family's investment firm later became a co-owner of Rockefeller Center with Tishman Speyer. That's the deeper lesson. The wealthiest families think in systems: real estate, banking, construction materials, operating companies, debt, equity, control. To be clear, wealthy real estate families do sell. They prune weak assets. They recapitalize. They exchange one location for a better one. They bring in partners. They refinance. They restructure. But they do not treat trophy real estate like inventory. They treat it like a private bank. A building can produce rent for decades. It can be refinanced without the same consequence as a taxable sale. It can secure debt, fund new deals, employ family members, and preserve control. Most investors chase the exit because they need the win. Family offices chase permanence because they already understand the win. The win is not selling the building. The win is owning it when the loan is paid down, rents have reset upward, land has become impossible to replace, and the next generation has a base they did not have to build from scratch. That is why the most powerful real estate families are not asking, when do we sell? They are asking, how do we make sure the grandchildren still own it? Subscribe for practical lessons on business, real estate, and the deals that make or break wealth.